The old good student tradition. All the people are sitting in the far rows, actually, when the first and second is almost empty. Cannot say it is good, but it's okay. Some of the most experienced students are standing at the back. Today, I want to say welcome to all of you, and especially to our online audience, because today is a special day because of school vacations. We have more people watching and listening us online than in this lovely space provided to us by SEB Banka, this SEB Innovation Center. And I must start with saying thank you to SEB and to their lovely facilities.
We are very happy.
Thank you so much. What to expect today? First of all, I want to congratulate you with start our current season of Angels School or Angels Academy, whatever. And what is the main difference for the current program? First of all, it is created to be hybrid, not only for us in Riga, but for a lot of our colleagues and fellows that are listening us online. This is a part of our LatBAN strategy. We are still in transition from the local fellowship of private investors to become a Baltic player, or probably in the next year, Baltic plus Nordics. You know that we spend a lot of time to contribute to our international development, and it started to provide some kind of return for us, for our startups, and for our portfolios as well. I must say that today's session is supported not only by Ministry of Economics, but also by United States Agency for International Development under the special tailored Innovate project backed by the American people. They help us to do this online hybrid experience. And then I have to say that with this support, we can have our sessions more interesting, more focused, and more special for our guests. What to expect today? First of all, the very special-oriented lecture or keynote from Nikolais Petrovich, the famous financial expert in Riga, in Latvia. They are providing their services not only to small and medium businesses, but also to startups, as far as I can understand, at a very affordable price for early-stage startups. This special tailored lecture about startup finance will be followed by a short break, and then a pitch session of 4. In this slide you can see 1 Estonian and 3 Latvian. Actually, one of those startups should be Lithuanian. It's just my mistake to provide the wrong flag. And because we are learning from each other, this time, our most experienced angel investors will provide the so-called investment opinion. This is the first sight to the startup pitch, startup deck, and understanding what are the key risks, what are the prospective advantages and upsides, and what kind of information we still need from startup to start making our investment decision. That's all from my side. I want to invite Nikolais to this stage and start the very important part, just not to be forgotten. This QR code is pointed to the Telegram group where we, our lovely keynote speakers and analysts will be providing the study stuff, surveys, and just a place where to exchange your opinion, put some critics as well to the organizers and to the content. So please join us in this Telegram group, and I will share the link for our online audience a bit later. So, Startup Finance Uncovered.
Yep. Good afternoon. My name is Nikolais, and my whole career journey was related to the finance. And during the last years, many people asked me, what will you do when artificial intellect will replace you? And I believe I can start making tarot spreads or astrological mind maps because I have enough experience in future prediction. Of course, I don't have these beautiful cards, tarot cards with beautiful pictures, but I have beautiful Excel with nice formulas. And today, we will kind of combine this future prediction and financial modeling. So during today's workshop, today's keynote, I'll tell a little briefly about myself and about John Colt to just add some credits to my work. We will tell about the future, why it is important in the decision of investment and basically for the startups. We will go through the financial modeling for the scenario planning, key metrics. We'll show how to track some KPIs, and then in the end we will show some examples how we made forecast for one real startup. Okay, John Gold. John Gold is a CFO on demand or fractional CFO, you can name it differently. Basically, we are helping to small, medium size, to startups, to large companies to deal with their finances. We are providing all the financial statements, we are finding all the risks, we are providing all the opportunities to grow. Basically, we are replacing the finance department and we are helping to grow to the founders. We're starting from structuring all the data, then we are going to financial reporting, FP&A, and with strategic advices. So if you have business or if you are planning to do business, so don't hesitate to ask us to help. Speak about myself, I have 12 years experience in finance in different stages, in different spheres. So basically during the past 5 years, I was working in C-level position in different finance companies, as in startups, as in large development companies. And for the last 2 years, together with my partner Alex, he's here, we are building the John Gold company to kind of distribute our finance knowledge to other businesses. Okay. 5 years ago, I believe, when I was fundraising as a CFO of fintech startup, I have prepared 40-page pitch book and have sent it to 100 investors. And I did it through the special soft that I could see at which slide each investor pay more attention. And basically 40 slides was kind of bad decision for myself because only 3 slides were considered. The first slide is team. So almost each investor who had opened the presentation, he paid attention on team. Then on the market or business model, and some investors, they have considered kind of financial model for the future, financial metrics. And basically the research made by venture capital, they kind of have found the 5 main reasons why investor decided to invest to particular startup. First one is scalability, so how startup could grow, how fast, and how costly it could be. Second one is market opportunity, how market is growing, what is the market. Strong founding team, of course, so team is a key point, and basically almost each investor, when we are asking what is the main reason for you to invest, is a team. Innovation, disruption, and basically as kind of a summary of it is potential high returns. Because sometimes there are situations when it is not a growing market, the business is not so scalable, but it still has potential high returns and investor can invest here. But basically, all those reasons are about the future. So yeah, if we are speaking about scalability, we are thinking how business can grow in the future. If we are speaking about market opportunity, it is how market would be in the future. For example, in 2022, the market of COVID masks was huge and it was fast growing, but we understood that this market most probably doesn't have a future because it is only kind of black swan event and we cannot predict that it would be in the future. So that's why for investor, especially for angel investor, it is not a great opportunity. Strong foundation team. Again, we are thinking how team can deal with different situations in the future. For example, if you have a startup with a founding team from Google, from, I don't know, from Facebook, etc., but all of them are 90 years old, most probably you will not invest because literally lifetime value of this team is not so big. Innovation, disruption, again. So if we are speaking about innovation, we are speaking about the future. So, and it is kind of, I believe, the secret power of a great investor who can understand which innovation would be in demand in the future. And of course, I cannot help you to, and I don't know how we can evaluate how the team would be in the future. I believe we can work with psychologists, we can, I don't know, make something, maybe some specific interview to understand it, and maybe experienced investor can do it. And, but we can work with finances, we can work with already existing business, and we can predict the future based on their number. We can predict the future based on market where the startup exists. And basically, to predict the future, we need to understand the history. We need to understand which metrics the startups has until now. So basically, some basic word about P&L and why it is important. So I'm sure that everyone understands how P&L looks. So basically, to start make forecast, we are kind of combining all the basic information we have, thousands of different sources in the simple financial statement. In finance book, page 12, you will see that financial statements are P&L, balance sheet, and cash flow. Basically, we can maybe, for now, exclude balance sheet. Of course, it is important because it shows how many debts do you have. It shows some, I don't know, some of your assets. But basically, if you want to make forecast for your finances, you can work with P&L primarily and for cash flow secondarily. So revenue, it is all your sales that you have, and basically we need to understand that revenue we can divide on the recurring revenue. It is revenue from subscription and one-time revenue if you are selling something. We can differently kind of interpret it what is the revenue, but we need to understand, for example, if you sold something but the client will pay you in 1 month, you can already now record it as revenue. For example, if you have attracted investments or take a debt, it is not revenue because some startups show that it is kind of inflows, that's why it is revenue. No, it doesn't work. So regarding the COGS, it is cost of goods sold. It is the costs that are related to each particular item. With tech startup, it is really hard to evaluate the COGS. Therefore, many startups, they include cost of acquisition to the cost, some sales cost to the COGS, but still we always have, let's say, Google and Apple fees. It is COGS because if higher revenue you have, higher fees would be, for example, for tech startup, or some Stripe costs, some acquiring costs. So basically, COGS should be added here. And if revenue is higher than COGS, so then business could be scalable. Your EBITDA could be negative. Many of large business, many of unicorns have negative EBITDA, but gross profit couldn't be negative. So it is extremely, it is no sense to grow if your gross profit is negative. Of course, on the initial stage, maybe there could be the situation when gross profit is negative, but basically you cannot scale while you have this situation. Yeah, when we have gross profit, we can add sales cost. It is cost related to the sales. We can include marketing here. We have OPEX, all the software, all the offices, all the operational costs, accounting, banking, etc. Salaries, all your team, and all other salaries. Sometimes business owners say, okay, I have development team and I will capitalize my asset. So it is not my expense, it is my investment. So, and they exclude salary and they add it to investment because they're kind of capitalizing their investment salaries. And from the accounting point of view, from the valuation point of view, it is maybe good. So we can show, okay, we have higher EBITDA. But from the reality, it works that you most probably, when the product would be realized, you will not fire all the developers because you will need to support, you will need to add new features, you will need to continue to develop the project. If, for example, you will fire all the developers after the product would be realized, you will have assess.com, the web page, who is not kind of growing and developing. So, because that's why maybe for some reasons you can play with these numbers to increase your EBITDA, but if we are speaking about the forecasting, if we are speaking about looking forward, so we need to be honest with ourselves and we need to add all the salaries, and we need to understand, okay, currently we have negative EBITDA because of salaries, and we will keep half those salaries because we need to have this amount of people. Of course, we can capitalize it, but still our EBITDA would be negative. And if we have any debts and assets, we also have interest rate depreciation and tax. But in Latvia, for example, in such countries as Latvia, when we don't have tax on the undistributed revenue, so basically usually all the main metrics are related to EBITDA, not to the net income or to the EBITDA. Yep, and when we have kind of historical forecast, we can go to the future and we can start making the forecast for this P&L. Starting from the revenue, so first of all, we need to understand the component of this revenue. If it is a subscription-based business, it is easy because we have cohort of clients who came to us 2 years ago, cohort of clients who came to us 1 year ago, and new cohort of clients. So we can see how it is decreasing. So because most probably people at one point of time stop using your app, your product, but we can at least predict their revenue from those clients. And then we can predict the new users that will come. But when we are predicting the new users, we need to understand several things. First of all, we need to think about seasonality because there are a lot of business that are really kind of volatile in terms of seasonality. So, and of course, we need to kind of use it, and we cannot just think that, okay, we will have a kind of flat growth rate for our users. And we need to think about the capacity because capacity, let's consider it from 3 sides. The first side is market capacity. It is really, I have heard a lot, and I believe US investors as well, heard a lot of pitch when business owners say, we will have 50% of market share by the end of this year, and basically we will continue to grow with this space. No, basically there is no right answer which market share is affordable, but kind of it is good when your business model looks great if you reach 5% market share. Also, speaking about the growth rate, you need to understand why you're small. While you're small, it is easier to grow because if, for example, you have 100 clients and you added 50 clients, your growth rate is 50%. But to continue grow with this growth rate, you will need to increase your number of clients significantly. One of our clients some time ago, he had extrapolated the growth rate of the first year, and in 5th year, his revenue was more than global GDP. No, I mean, it doesn't work. Maybe it will work and I will be surprised, but most probably not. So the capacity, so we need to understand what is market capacity. So we need to understand at one time our growth would be slower, slower and slower. And another part of capacity, for example, if we can use the growth rate for the leads, we need to understand, okay, if I'm increasing the number of leads, I need to increase the number of sales person who will work with those leads. If I will increase the number of clients, then I will need to add some new, I don't know, API, some technical stuff to my application because currently it can work only with 1,000. If, for example, I have physical business, I don't know, barbershops, then I will not work with 100% occupancy rate because there are some hours. If I invest, I don't know, all the money in marketing, nobody will go to me from 12 to 1 p.m. because people are working the time. So basically, we need to understand that there is capacity that is extremely high, extremely difficult to be higher that this capacity is. The same with COGS. Basically, we have a kind of COGS, cost of goods sold. We have a share of revenue, and in theory, it should be decreasing with the time because it is so-called economy of scale. For example, you have production and you need to order raw materials from China. If you are producing only 100 items, the costs are the following. But if you are producing, I don't know, 1,000 items, you will save money on logistics. You can receive some discount because you're higher, and you can save more money. In terms of technical startups, sometimes it can start increasing because the market penetration increase and each new client is more expensive for you. So you also need to understand it. And if you are going to the next market, it doesn't mean that you will have the same cost of acquisition because each market differs. So that's why we need to understand kind of, again, capacity and share of revenue. And for example, again, about the capacity. For example, if you work in production sphere and you are counting your COGS, you know that you have one supplier who can provide you so much raw materials with this price. But you need to understand his capacity because it doesn't mean that you will have another one supplier who will have the same terms. So basically, speaking about the COGS, we have a lot of bottlenecks as well as with revenue that we need to take into account to have more precise forecast. The sales cost, and OPEX, basically, it would be, right business scalability if your OPEX is decreasing as share of revenue when you are growing. So, because if your revenue grow 100 times, it doesn't mean that you need 100 times higher office, bigger office, or it doesn't mean that you need 100 times more accountants. So that's why OPEX will grow, but it wouldn't grow with the same proportion as the revenue grows. With the salaries, there are a lot of methods how startups evaluate the future cost of the salaries. And usually they are using kind of a share of revenue. But it is not right approach as well because, again, if your revenue increase 100 times, many of your team members will have the same salary. So basically, you don't need to attract new people. And the right way is to kind of set KPIs to, for example, say, okay, if we are growing, if we will need to increase our revenue 100 times, it means that we need so many sales. For so many sales, we need so many team leads. For so many team leads, we need this sales director. In terms of product, we need to add this feature. Okay, my dear CTO, please answer me how many people do we need to realize those features, etc., etc. So basically, it should be a plan of certain position for certain time with certain salary. Again, please remember the salary should grow. We also need to add it to the financial forecast. Basically, price will grow as well, but the good financial forecast, the good financial model works when salaries are growing, but price is not growing, and you still have affordable ARR. And yes, and if you have any debts, and if you're planning to attract some no debts, so it affects your interest rate as your cost, and you need to take it into account as well because it will influence your cash flow. Basing on P&L, we can say either business is good to scale or not. So if looking at EBITDA tendency, looking at revenue growth rate, we can say, okay, business is scalable. And we can say that business is good idea or not idea. Many of valuations are based only on MRR or EBITDA multipliers. But if we want to understand, okay, business is scalable, how much should I invest or how much should I attract investment to scale this business? When I will receive dividends or some another benefit from this business. In order to do it, to understand kind of the health, not of business model, but of business itself, we are building the cash flow. And like the top level of the cash flow is our operating cash flow. Operating cash flow is the same as EBITDA, so it is EBITDA. We are adding here depreciation because depreciation, it doesn't exist in reality. Depreciation is something that accountant imagined just to decrease your taxes. So that's why we can add it. Of course, if you have a lot of physical asset, you can have stabilization fund and maybe you can have real cash transaction as depreciation, but in reality, it doesn't exist. Then you need to understand change in payables and change in receivables. I will explain. For example, you have team who has produced something that you have sold for 1,000 euro, and you have paid to this team 500 euro. It means that your gross profit is 500 euro, but you have received advance payment from your buyer, and let's say in January. in February your team has produced this service, and in March you have paid to this team. It means that your net cash flow in January you have plus 1,000, in February you don't have any cash transaction, and in February you have minus 500. And in this way, if we are considering the business knowing all the payables and receivables, we can because in this way we can see that we don't need investments. We kind of are receiving money from the buyer, and we can invest this money to produce product. Another way, for example, if we know that we are kind of producing cost are 500 and selling cost are 1,000, so it means that we have kind of 500 gross profit. Our OPEX is 1,000. It means that we need to attract investment for 500 to be on the break even. But again, if we need to pay in advance to our suppliers, and then we only in 2 months will receive money from our buyers, it means that we will have gap much more than 500, and that means that we need to take it into account when we are attracting financing, because kind of this J curve, it would be shifted to the left, and yeah, because kind of we need to invest more money, we need to freeze more money, and our return would be later. Again, in cash flow, we need to plan all the capex investments, because if we want to, I don't know, go to the new market, we need to understand, we need to go to the new level of production. We need to understand, okay, how much money should we invest in the capex, and how much money should we then add to stabilization fund, how much money should we add to support this capex, etc. As well as other investment. I don't know, maybe at some point we are going to buy a new company to just enter to the new market. It is also investments that basically you need to take into account planning your cash flow to understand what is the deepest part in this J curve. The deepest part is the amount that you need to attract from the investor. And then when you have kind of all the cost part, okay, we need to understand when we will find those money to realize all our crazy ideas. And we are using fundraise in our cash flow. There are a lot of like different ways how we can fundraise. We can attract equity. We can, I don't know, take a debt. We can have, I don't know, some IPO. I mean, a lot of different ways. But anyway, it means that at one point we will have kind of cash inflow that basically should be higher than this deepest part. However, I mean, the ideal case when the curve is like this. So when we are attracting investments and when our investments are finished, we have positive EBITDA for the project, and we can keep operating in the market. Usually, especially in deep tech startup, you are attracting the investment just to realize some milestone to attract some seed round, pre-seed, post-seed, Series A, bridge 1, bridge 2, etc. So that's why to understand the sum, how much should you attract, you need to understand how fast can I be on the break-even, how fast my EBITDA should be positive, or how much money should I need to reach the next important milestone to increase my valuation.
Right. Is it possible to interrupt you with a very interesting question?
Sure.
Let's say, because we are learning from each other, what, at your opinion, the best time or period to ask for huge investment round for a startup? Based on this curve, actually.
Based on this, I mean, basically we need to do it somewhere here, because to go here we need to have money. So, but for example, if we understand that we need another round, etc., we need to have like 6 months at least, 6 months advance, because some startups, when I'm like in our event from Warsaw, I have heard that companies say, okay, we have runway 2 months. Okay, most probably goodbye, because I mean it is bad news for you, because even term sheet consideration could be 2 months. So at least I believe 6 months. So if we understand that, yeah, we will not have positive EBITDA with this round, so we need to have significant milestones, and we need to have higher valuation after 12 months, and then we need to have 6 months to finish the next round. So if we our seed round or pre-seed is for 18 months, then we need to have at least 6 months gap between we will be out of money. And basically, looking at the cash flow, we need to, or investor need to understand, okay, I have invested to this business. When will I receive any benefits? So is it exit business or will you pay dividends? So please show me it in the cash flow, and is it related to your current situation? So basically, extrapolating the data for the future, so we can see how investor not only invest but receives the benefit as well. Yep. I believe it doesn't work. Yes. And basically, working on the forecast, we are considering only one scenario. So it could be maybe positive scenario or could be pessimistic scenario, but it's only one scenario. In the reality, we have, infinite number of different scenarios. And it is what tools can we use to consider as many scenarios as possible. And basically, one of it is sensitivity analysis. It is easier tool in Excel or spreadsheet you can use when you can choose one variable, for example, COGS, cost of acquisition, and another variable, for example, LTV. And you can run 100 different models, and you can see the different IRR in each model. And then you can make borders for yourself. Okay, my model work if my cost of acquisition is lower than 5 and my LTV is higher than 100. And you can do it for different variables. You can have, 5, 10 different sensitivity analysis, and you are making your borders for yourself. And when you're speaking with your team, you can say, okay, my dear marketing team, you can do whatever, but cost of acquisition should be not higher than €5 per lead. Okay, my product team, so we can do whatever, but our LTV should be the following. And because you understand your frames, your borders, what are more appropriate for you. And it is more analytical stuff. You can, if you have junior analyst in your company, you can delegate it to him. More sophisticated task is stress test analysis. When you are working with the model and you stress test each variable. So for example, you're looking at the model and okay, so let's be honest, what would happen with my business if revenue would be 2 times lower, if price would be 2 times lower, if cost acquisition would be 2 times higher. And it helps you to understand the most important part of your business, because sometimes, for example, you can increase your accounting cost, 10 times, and it nothing influence your business. But for example, you can increase your cost of acquisition by 1% and you will go bankrupt. So that's why working with stress test analysis, you understand the most important metrics for your business. For each business, it are different. And when you understand it, you are focusing on it, because usually there are like 2-3 metrics on which you can focus, and you can almost ignore all other one and go only with such metrics. There was example, for example, one of our clients is EdTech platform, and they were spending a lot of time to increase their ARPU, average revenue per user. They tried to add some new pricing policy, add new upsells, etc., etc. But then we calculate, understood, by increasing ARPU by 20%, their valuation will grow only by 10%. But for example, if they increase retention by 5%, their valuation will grow 2 times. So that's why let's focus on the real important metrics, and we'll think how we can change it. We'll think how we can invest to increase the metrics that really will affect our goal. And regarding the key metrics, there are thousands of it. And for each business, it are different, but I believe those 5 are the most common. First of all is MRR and ARR. I mean, really a lot of companies are focusing only on it. I know some founders that understand that they have large enough margin and they can ignore all the costs, all the COGS, etc. Okay, my target is just to add some new revenue, just to add some new clients, and we keep going and keep working only on increasing the revenue. Even many investors, they kind of invest only what is your ARR, and let's multiply it by 10, it is your valuation. So basically, it works on the both sides. And many investors and many startups, they interpret the ARR differently, because ARR is annual recurring revenue. First of all, it is recurring revenue. I have met a lot of pitches when founders say, okay, my ARR is, I don't know, 1 million, and half of it is upsells or something like that. No, if you have some not recurring, it is not your ARR. So ARR is like kind of revenue from the subscription that you can kind of foresee, that you can predict. But okay, so for example, you can add it to recurring revenue, but you need to make this adjustment on the multiplier then. And with the annual, there are different ways. So usually the startup just multiply the previous MRR by 12. And it is a tricky part, especially for the business with high seasonality, because they, okay, we have multiplied our summer MRR by 12 because we are app for fishers, I don't know. And I mean, in this point, of course, the ARR is huge, but basically it don't have any common with reality, because we need to understand what is average MRR per year, and then we can multiply by 12. Or there are other startups who say, okay, we have MRR currently, I don't know, 10,000, but we will grow, and our ARR kind of for the further year will be the following. But if we are kind of providing the metric for future, so you will need to provide the discount rate as well, because there is probability that you will not have this ARR. Regarding the customer acquisition cost, again, there are some different ways. One type of people, of investors, of startups, they just calculate cost per lead, cost per acquisition, cost per lead, cost per download. I mean, targeting costs that they have invested into the Facebook directly, onto the Google directly. And other people, for example, they are counting all the salaries of marketing team, all the development of the marketing banners, etc., and divide it all by the numbers of new users. And I don't know the right approach, because basically by the theory, it works in both ways. But you need, if you're considering two startups, if you're comparing two companies, you need to be sure that they have the same methodology besides the cost of acquisition. Regarding the customer lifetime value, it is easy. It is how much money the customer can attract during his lifetime value. So we need to understand the churn rate, how many customers we are losing each year or each month, and then we need to understand how long the average customer stays with us, and multiply it by the average revenue per customer. For some companies who provides, who have high COGS, who provide some hardware solution, we can calculate the gross customer LTV, so customer LTV minus the production cost that we are spent for this customer. Churn rate and retention rate, yes, churn rate, how much customer do we lose each month or each year, and retention rate, how big percentage of customers stay with us. Yep, and when we have kind of our beautiful model for the future, we can see how much we can earn. We need to kind of make reality check. So when we have included all the numbers, and we can understand, okay, our target is to grow 1,000% per year. And maybe it is kind of real, especially if you're a small one, because so, I mean, it would be only the next October, October 2025. So we have so many time to realize all our idea, to reach the market, to earn so much revenue. And how we can assess, is it real or not? First of all, what we are doing with some businesses, we are kind of dividing by stage. Okay, if our target is to grow 10x per year, so it means that we need to grow at least 50% per month. And is it real for the next month that you will have 50% more clients? Most probably we will say, okay, no, it is not real because we will start to grow slowly and then a little faster. And working with it, you can adjust your strategy and you can then consider historical value, because if you are saying, okay, we need to grow 50% per month, but all the previous months we grew only 12% per month. So what is changed? So if nothing changes, it most probably result would be the same, and you need to put your target based on this historical growth rate. Or if you kind of see that your target is reachable only with higher growth rate, you need to change the strategy of your customer acquisition or retention or something else. Yep, and then when you kind of see all your targets, you need to assess probabilities. So think, okay, what is the market share? How is the market growing? Because if I'm growing 5 times faster than my competitors, most probably it is not real, or maybe I should know some secret sauce why I should do it. Yep, and in the last my part, I will go through one real example of how we have made the forecast and predicted the company growth rate and made valuation based on it. So it is Indian-based tech startup, I will not call the name, who already exists for some years. And first of all, we kind of speak about the P&L. The highest part is revenue, but to understand the revenue, we divided it into the existing revenue from the existing customers, and revenue from the new customers. Speaking about the existing customers, we just need to understand the churn rate, and we need to understand how many of existing customers will stay with the company at each point of time. Speaking about new customer, it is a tricky part because we cannot understand how in the future we can attract new customers. So that's why we went to the sales funnel, and we understand, okay, first of all, the company attract leads. Okay, we kind of can predict it because we know the cost of lead, we know the possible investment to the marketing, so we know the previous growth rate, and we know the seasonality. So we have used we put high season, low season, put historical growth rate. We didn't decrease this growth rate because we are increasing the cost of lead. And we see the predicted number of leads. Then we understand, okay, if we will have so many leads, can our current sales team work with this number of leads? Can we have the same conversion from leads to customer if the current sales team will work? No, because our current sales team already is fully busy with number of leads that is smaller. So that's why we need to understand, okay, we are attracting some new leads, then we need to attract some new sales member, and we need to attract sales member before our leads number would be so high that our current sales will not be able to work with it. So that's why we are putting kind of all the BDE, it is kind of business development employee, before it, thinking about how many leads they can work with. So then we understood, okay, we have 2 products. We have products with monthly subscription and with bi-monthly subscription, basically each second month. So that's why we kind of made the calculation for those one to see how big revenue we can have in nominal value. So having the revenue, we understand our COGS as it is a tech platform. In this case, the COGS was the teachers who spend their hour and then charges for us. And basically, we are counting it as not share of revenue, but we are counting how many hours should they spend and how it would be cost for us. So then we need to understand, okay, so if we are going to reach this market share, how many change in products should we do? So we are considering it with other market players. Then we made estimate, so what should we add? And we are counting, okay, in order to do those changes, we need to add some new developers in the team with this salary. So, okay, we counted it to the product. Then, as we see that retention is the most crucial part, then we need to think, okay, we will add some new client, but how we will work to decrease churn rate of this client, how we will make those clients be with our platform as long as possible. So that's why we need to do more content. So we added some special business developers and content creators to work especially on retention. So, and when we have kind of all those metrics, we have P&L, we have cash flow, and we can see, okay, currently we are negative, but at that point of time we will be positive, and we can say for investor how much money should he invest and what would be the possible valuation of his investment. And then it is kind of the forecast with no change. So basically we just took historical data, we just took the target and tried to draw the line how we can go from our history, from today to our target. But then is the most interesting part, how we can make our journey more effective, how we can increase our target, or how we can reach our journey with less investment. And that's why we kind of put all the main metrics and played with numbers. Okay, let's increase, let's say, sales per business development employee by 10%. Let's increase share of leads to customer by 10%. Let's increase retention rate by 10%. And we can see, okay, what is important and what isn't important. And for example, if you are increasing sales per number of leads per business development assistant, our revenue grows by 10%. But if we are increasing retention rate by 10%, our revenue grows by 30%. And so we now focus, and then we are working with product team, and there is a new target how we can kind of reach these retention rates, these KPIs. And if it is possible, so we are focusing on it. We are kind of cut all not important stuff and going to the future to reach our valuation or another target. Yep. Is that it?
Wow. But let me start with a question from the online audience. Nikolai, can you please share? The question sounds like, how do you evaluate the market capacity, and which model is commonly used to forecast the market share? I don't know what is the question, which model, because there are no, let's say, commonly adopted and named models. Can you share your insights on that?
Yeah, about the market capacity, there is like TAM, SOM, this is total addressable market, service, total obtainable, service obtainable. So basically, you understand what is your product, so you understand the number of people who can be interested in this product. Then you need to understand, okay, basically you have two markets usually. You have beachhead market when you start, and you have global market when you can go. For the global market, again, you need to understand it is not easy to go globally on the day one. So strategy to go to the African market and American market is absolutely different. So then you understand kind of your market when you are will be develop a product. You understand the number of competitors in this market, the number of people potentially who could be interested. For example, if you have pet owner app, so you can in Google find how many there are pet owners. Then you can statistically find how many of them earn before, I don't know, minimum wage, so because they can pay for your app. And then you can divide it by the number of competitors, and you can add, I don't know, that the number of competitors will be doubled, and you can see, okay, we have 3% share of those people. It is our market, and our target is to reach this market. And if you can become kind of unicorn, you can reach 1 billion valuation with 5% market share, I believe this idea is great. If you need to reach 1 billion valuation, if you need to reach half of the global market, it would be difficult, I believe.
More questions?
Ratio analysis?
Ratio analysis, sure.
What would be your favorite ratios?
Okay, it depends. Currently I was considering, you know, the Polish company Żabko. It is a huge company. I mean, they have, I don't know, it is kind of Narvesen, but in Poland. And they have kind of something between Narvesen and Maxima 1X.
Let's see.
They work on weekend, and that's
Yeah. I mean, and they,
a problem.
yeah, I mean, I just, because they will have IPO soon, and I just considered their financial metrics. And they kind of have huge growth rate, they have huge possibility, they have, I don't know, in terms of market capacity, market is again huge because they are in Warsaw, there are a lot of them, but in other Poland they have space. But their interest coverage ratio is 74%. It means that 74% of their EBITDA they are paying to cover the debt, not to pay the debt, only to cover the interest ratio. And for me, it was huge risk ratio. I mean, not risk ratio, but huge risk. That's why I believe it is very important to see all the debt-related ratio because especially the not possibility to pay the debt makes the company bankrupt. So that's why current ratio, quick ratio, debt coverage ratio, interest coverage ratio are the most important. But if we are looking on the kind of growth rate, there is a rule of 40. I don't know, do you hear it or not? So that your growth rate plus gross margin should be more than 40. I believe it, not net growth rate plus net margin. Yeah, it should be more than 40 in terms of percentage. So it means that basically we need to have, okay, there is kind of high marginal product and we have kind of high growth rate. So that's why it kind of shows that business has huge potential.
What about lifetime value of customer versus cost of acquisition? What's the ratio that you would think that that business is scalable or not?
Sure, but we need to understand that this is a tricky part because lifetime value of client, cost of acquisition is growing with the time. So we need to understand, so we can divide it, kind of understand the payback period for the customer, but then we need to say, okay, what is the capacity? How many customer else we can attract with this payback period? So if we are going in new market, would be the payback period the same? And that's why there are a lot of, we cannot see only isolated this metrics.
Let's thank to the Nikolais once again. And probably we have to make a short 10 to 15 minutes break to get some refreshments and then switch to the second part.